All right, so welcome to another deep dive. Today we're going to be tackling something that's pretty much the foundation of any business that, deals with physical stuff. We're talking about property, plant, and equipment, or as the cool kids say, PP&E.
Yeah, sometimes called plant assets or fixed assets, but it all boils down to the same thing, the stuff that companies use over and over, not the stuff they're trying to sell. And
Yeah.
it's got to last, or if we're talking long term here.
Right. It's not like inventory that flies off the shelves. These are the big guns, buildings, the land they sit on, the machines that make the magic happen, the stuff that keeps the lights on and the operations humming.
Exactly. And that longevity is a key point because it ties directly into how we account for these assets,
Yeah.
starting with a very fundamental concept, historical cost.
Historical cost. So we're not talking about what you could sell it for on the open market today. We're talking about what it actually set you back when you first got it.
Precisely. It's about that initial transaction, that reliable number that we can look back on and say, okay, this is what they actually paid for it. Of course, the purchase price is just the starting point.
Hmm.
We also have to consider all the additional costs necessary to get that asset up and running, ready to do its job.
So that means factoring in things like sales tax, which, depending on where you are, can be a significant chunk of change, and then all the costs associated with getting it to your location, the freight and shipping, which with the price of fuel these days.
You're not wrong. And don't forget about the costs once it arrives. Getting it set up, maybe it needs assembly, installation costs for sure, and crucially, any testing that needs to be done to ensure it's working as intended, all of that gets rolled into the initial cost of the asset.
It's like a snowball effect. So you've got to wonder, in a world where markets are constantly fluctuating, where the value of, say, real estate can skyrocket or plummet, why stick to that original historical cost? Why not update it to reflect the current market value?
Well, there are definitely pros and cons to both approaches, and our sources do point to the potential disconnect between the historical cost and the fair value, especially for assets held over a long period. But the rationale for sticking with historical cost really boils down to reliability and the principle of not recognizing gains or losses until an asset is actually sold. It provides a consistent and verifiable foundation for financial reporting.
So it's like until you actually sell it, any potential gain or loss is just on paper. It's not realized. Let's dive into the specifics, starting with land. I always thought buying land was pretty straightforward. You agree on a price, shake hands, and that's that. But our research shows it's a bit more complicated than that.
Oh, it can be a lot more involved than you might think. Beyond that sticker price, you've got a whole bunch of closing costs that can add up quickly. You've got fees for the title search to make sure the seller actually owns the land, and then legal fees for the lawyers to do their due diligence, draw up the contracts, and make sure everything is legit. If you're working with real estate agents, you've got commissions to factor in, and don't forget about the fees that local governments charge to record the transfer of ownership. And then, if the area has benefited from public improvements, things like new roads or sewer lines, you might get hit with special assessments to cover your share of those costs.
Wow, so it's all about making it legally yours, getting all the paperwork squared away. But what about getting the land ready for its intended use? What if you need to level it out or get rid of some old structures?
Yep, all of those site preparation costs also get capitalized as part of the land's total cost. Think of it as getting the land to a point where you can actually build on it or use it for whatever purpose you have in mind. We're talking grading to even out the surface, filling in any low spots, making sure there's proper drainage. If there are trees or old buildings that need to be cleared, those demolition costs come to play. And here's another thing. If the buyer takes on any existing financial obligations tied to the land, say, like unpaid property taxes that the previous owner left behind, or maybe even an existing mortgage on the property.
They're adding that to their cost basis.
Precisely. Those assumed liabilities become part of the total cost of the land. And finally, any improvements to the land that are considered to have an indefinite life, like landscaping that you expect to maintain for the foreseeable future,
Yeah.
or a drainage system designed to last indefinitely, those get included in the land's cost too.
It's interesting because I saw in our materials this distinction between just land and land improvements. What's the difference there?
It all comes down to useful life. The land itself is generally considered to have an unlimited useful life. It's not like it's going to wear out or become obsolete, so we don't depreciate it. But any improvements made to the land that do have a limited lifespan, those are treated differently. Think about things like private roads, sidewalks, fences. Those eventually need to be replaced or repaired. So those costs are recorded separately as land improvements, and they are depreciated over their estimated useful lives.
So it's not just about what you do to the land, it's about how long those improvements are going to last. Now, what if a company buys land, not to build on right away, but as an investment, hoping to sell it later at a profit? Or what if they're a real estate company that buys land specifically to develop and sell? Where does that fit in?
That's a crucial distinction, and it really comes down to the company's intent and their normal business
Yeah.
operations. If a company buys land purely as speculation, betting on appreciation, that's typically classified as an investment property on their balance sheet, not as part of the PP&E used in their core business. But if a real estate company buys land with the clear intention of developing it and selling it as part of their normal activities, then that land is considered inventory, just like the houses they build on it would be considered inventory.
It's all about the context. Speaking of context, let's take a look at a real world example from our research Tesla's acquisition of their factory site in Austin, Texas. Big news at the time. What kind of costs were they looking at?
Well, they started with a purchase price of $2 million for the land itself. But as we've discussed, there were some existing financial obligations tied to the property. They assumed $42,000 in unpaid property taxes that the previous owner hadn't paid. And there was also a mortgage on the property with $210,000 still outstanding, which Tesla agreed to take on. And just to add to the fun, the city slapped them with a $38,000 assessment for recent local improvements, roads, utilities, that kind of stuff.
So, right out the gate, they're already over that initial $2 million. What else do they have to shell out to get this project moving?
Well, like any real estate transaction, there were the usual suspects. Real estate agent commissions. They paid $120,000 for that. Then there were the title search and transfer fees, legal stuff, that was another $4,000. And there was an old warehouse on the property that had to go. Demolition cost them $10,000. The good news is they were able to salvage some materials from the demolition, brought in a cool $1,000. Surveying and grading the land cost them $30,000. And finally, to make the place look presentable, they spent $101,000 on landscaping. Now, that landscaping was estimated to have a useful life of about 20 years.
All right, time to put our accounting caps on. If we're looking at all of that, what would Tesla record as the total cost of the land itself on their books?
So to get that total cost of the land, we got to add up all those expenditures directly tied to getting the land and making it ready for its long-term use. We're talking the $2 million purchase price, the $42,000 in back taxes, the $210,000 mortgage, that $38,000 city assessment, the $120,000 in real estate commissions, the $4,000 for title work, and then the net demolition cost of $9,000.
Yeah.
We got to subtract that $1,000 they got from salvaging materials. And finally, we tack on the $30,000 for surveying and grading. All that adds up to $2,453,000 as the total cost of the land.
So that $2 million grew by almost a quarter million just getting the land ready to go. Now, what about that $101,000 for landscaping?
That's where that distinction we talked about comes in, because that landscaping has a limited useful life. 20 years, in this case, it's treated as a land improvement, separate from the land itself, which we don't depreciate. So Tesla would record the $2,453,000 the cost of the land, and then separately $101,000 as the cost of their land improvements.
And I assume there was a specific way they'd record all of this in their accounting system.
Absolutely. They'd use a journal entry to show how these transactions affect their accounts. They'd increase their land account by $2,453,000 and their land improvements account by $101,000. And to balance that out, they'd decrease their cash account or increase their liabilities for the money going out or the obligations they're assuming. So they debit land improvements, credit mortgage payable for that assumed mortgage, maybe credit an accrued liabilities account for those back taxes and the city assessment until they pay them, and then credit cash for the rest of the money they paid out.
All right, so that's land. Now let's talk about equipment, the workhorses of many businesses. What kind of costs come into play when a company decides to buy, say, a fancy new machine or a fleet of delivery trucks?
Well, much like land, it's all about getting that equipment in place and ready to roll. And just like before, we start with the purchase price, the agreed upon cost of the equipment itself. But then we got to factor in those pesky sales taxes. Don't forget those. And of course, we've got to get it to where it needs to be, so freight charges, shipping fees, handling costs, it all adds up. And sometimes you even have insurance costs during transit, just in case something happens on the way.
So we've gotten it delivered, it's sitting on our loading dock. What happens next?
Well, it's not always plug and play, right? You might have assembly costs if it comes in pieces. Then there's installation, getting it set up in its designated spot, maybe connecting it to utilities, that kind of thing. And a very important step, testing. We've got to make sure this thing actually works the way it's supposed to, that it meets all the safety and performance standards. Those testing costs are part of getting it ready for use.
But there's a line, right? I mean, once the equipment is up and running, not every expense related to it gets lumped into that initial cost.
Exactly. You've hit on a key point. The recurring operating costs that are part of just using the equipment, those are not included in the initial cost. We're talking about things like annual registration fees for vehicles, those licenses you need to renew every year, or regular insurance premiums that you pay to cover accidents or damage. Those are treated as expenses in the period they're incurred, not as part of the equipment's cost.
So if I'm paying my annual registration fee for my delivery van, that's just an expense for this year. It doesn't make my van inherently more valuable. It just allows me to legally drive it. Let's look at an example with FedEx. They're buying a brand new, shiny battery-powered delivery truck to add to their fleet. What kind of costs might they run into?
All right, so FedEx pays a cash price of $22,000 for this electric beauty. Then, because the tax man always gets his cut, they have to shell out another $3,320 in sales taxes. They want it to look the part, so they spend $500 on painting and getting those iconic FedEx logos on the side. And then separately, they pay $80 for the annual vehicle license and $1,600 for a 3-year accident insurance policy.
All right, so out of all of that, what gets capitalized as part of the truck's cost on their books?
So the costs that are directly tied to getting that truck ready to hit the streets and deliver packages, that's what gets capitalized. So we're talking about that $22,000 cash price, the $1,320 in sales taxes, and that $500 for this snazzy paint job and logos. That brings the total cost of the delivery truck to $23,820.
And the license and insurance, where do those fit in?
The $80 vehicle license, that's a recurring annual expense, so FedEx would recognize that as an expense right away, debit license expense. But the $1,600 insurance policy, that covers a future period, 3 years in this case, so they would record that as a prepaid insurance asset. Essentially, they're prepaying for that coverage, and then they'll expense a portion of it each year over the life of the policy.
So they're spreading out the cost of that insurance over the period it benefits them. And I assume this is all reflected in their journal entry.
Precisely. They debit their equipment trucks account for the $23,820, showing that the value of their trucks has increased. Then they debit license expense for the $80, and they debit prepaid insurance for that $1,600. To balance it all out, they credit cash for the total $25,500 they paid out.
Nice and neat. Let's try another quick example. Trader Joe's, they're getting a new commercial freezer to keep all those frozen goodies nice and frosty. What kind of costs might they face with that?
So they shell out $50,000 for the freezer unit itself. Then, of course, sales taxes, gotta love
Yep.
those, another $3,000. They're smart. They get insurance to cover the freezer during shipping, just in case something happens en route. That's another $500. And they always have installation and testing for these big pieces of equipment. Got to make sure it's working right, so that's $1,000.
Seems like a lot can go wrong between the factory and getting those ice cream sandwiches ready for sale. So what's the total cost of the freezer for Trader Joe's?
Add it all up. The $50,000 base price, the $3,000 in sales taxes, the $500 for shipping insurance, and the $1,000 for installation and testing. That brings us to a grand total of $54,500.
Pretty straightforward, right? How would they record this?
In this case, it's a simple journal entry. They would debit their equipment account for $54,500, showing the increase in their assets, and then they'd credit their cash account for the same amount to reflect the cash outflow.
So we've covered land, we've covered equipment. Let's move on to buildings. I feel like acquiring a building must come with a whole other set of costs and considerations. I know our research had an interesting example with a museum, the Art and Bloom. What was their situation?
The Art and Bloom Museum, a great example of how costs beyond just construction can end up being capitalized as part of a building's cost. So they had this plan to build this beautiful new museum. They hired the contractor. Everything was set. But then they hit a snag with the building permit. The city had this requirement. They wanted more green space.
Oh, the city wanted them to do some landscaping.
Not quite. They wanted a whole park. In order to get the building permit for the museum, Art and Bloom had to agree to fund the purchase of a piece of land next to the museum site, and that land was going to be turned into a public park.
Wow, that's quite the stipulation. So let's break down the numbers here. What were all the different costs they incurred for this project?
Well, the biggest chunk was the payment to the contractor for the actual construction of the building, a cool $31 million. They also had some additional security costs, specifically during construction. Got to keep things safe. That was $80,000. Their internal management team allocated $200,000 of overhead to the project. Then you've got excavation costs to get the site prepped for building, $100,000 for that. The building permit itself cost them $20,000. And of course, that park land funding, a hefty $150,000. They also had a dedicated project manager overseeing the whole thing. Their salary was $180,000. And here's a little bonus. They actually received $2,000 in donations specifically to help with the building cost.
Wow, a lot going out and a little something coming in. So, out of all of that, what actually gets counted toward the cost of the museum building?
Remember the key principle here. It has to be a cost directly related to getting the building ready for its intended use. So that $31 million to the contractor, that's in. The $80,000 for security during construction, definitely. Excavation costs, absolutely. That $20,000 building permit, without it they couldn't build, so that's in too. The $150,000 for the parkland funding, that's a trickier one, but
It was a requirement for the permit, so it's a necessary cost.
exactly. And then the project manager's salary, that's part of getting the building completed. So all those are in.
What about that $200,000 in allocated overhead and the $2,000,000 in donations? Those seem a little fuzzy.
Overhead allocations, they can be tricky. They represent resource usage, but often they're not directly attributable to a specific asset in a way that we can confidently capitalize. It's more about the general cost of running the business. And the donations, well, those are great. They help with the overall financial picture, but they're typically recognized as revenue separate from the building's cost.
So if we add up all those allowable costs, the construction, security, excavation, the permit, that parkland funding, and the project manager, we're at a grand total of $31,530,000 for the museum building.
That's the right number based on the info we have.
So the moral of this story is sometimes the cost of a building goes beyond bricks and mortar. Now, for a complete shift in gears, we need to talk about something called an asset retirement obligation, or ARO. It sounds intimidating. Break it down for us.
An ARO, it's basically recognizing that sometimes when you use an asset, you're also taking on a responsibility for what happens to it at the end of its useful life. Think about those massive oil rigs out in the ocean, or a nuclear power plant, or even something as simple as underground storage tanks at a gas station. There are often legal requirements to dismantle them safely, clean up any environmental hazards, restore the site, and those costs, even though they might be years or even decades down the road, they need to be accounted for.
So it's about recognizing a future liability today because of something we're using now. How does that actually work in accounting?
So the company first has to estimate what that future retirement cost is going to be, and then they record a liability on their balance sheet for the present value of that cost. We use present value because a dollar today is worth more than a dollar tomorrow, right? We have to account for the time value of money.
So we're not just throwing a random number on the books. We're using a calculation to figure out what that future cost is worth in today's dollars. But why does the cost of the asset go up?
Because that obligation to retire the asset, it's part and parcel of using the asset. It's part of the total cost. Then, over the asset's useful life, that liability is gradually increased, and that increase is recorded as accretion expense. It's basically like interest expense on the growing liability. And of course, that increased cost of the asset also gets depreciated over time.
Our sources had a good example with the Hillman Company and their rather unglamorous underground gas station tanks. What was their situation?
Yeah, not as exciting as a museum, but important nonetheless. Hillman Company, they knew they were legally obligated to remove those tanks eventually. They estimated it would cost them $100,000 when the time came, about 10 years down the line. They crunched the numbers, used a 6% discount rate, and the present value of that $100,000 came out to $55,839.
So that $55,839, that's what they recorded as the cost and the liability right off the bat.
Bingo. The day they put those tanks in, they would have debited their buildings account, because those tanks are part of the building, for $55,839. And to balance that out, they'd credit asset retirement obligation for the same amount, recognizing that liability.
So year after year, they're dealing with both depreciation on that extra building cost and this increasing ARO liability.
That's right. At the end of each year, they get a record depreciation expense on that $55,839. If they're using straight-line depreciation, that's $5,584 per year. So they debit depreciation expense and credit accumulated depreciation for the building. And then they've got to recognize the accretion expense on the ARO. The first year, it's the starting ARO balance, $55,839 times that 6% discount rate comes out to $3,350. So they debit accretion expense and credit asset retirement obligation. And that liability keeps growing each year as we get closer to that actual retirement date.
It's like a slow motion train coming, right? What are some other common scenarios where companies would need to recognize an ARO?
Oh, there are tons of examples. Anytime a company uses an asset and knows they'll have to clean up after themselves, essentially. The big one is decommissioning nuclear power plants. Huge undertaking. Then you have oil and gas companies. They've got to dismantle those offshore drilling platforms when they're done with them. Mining companies often have closure and environmental remediation costs. And even landfills, they have closure costs and then long-term care costs even after they're closed.
So anytime there's a legal requirement to retire an asset and it's going to cost money, AROs are in play. Let's look at another example. Wildcat Oil Company. They've got a drilling platform in the Gulf of Mexico. Sounds like a prime candidate for an ARO.
Textbook case. Wildcat Oil, they knew they had to dismantle and remove that platform eventually. Regulations. They estimated the cost to be $1 million 5 years down the line. Used a 10% discount rate this time, and the present value of that future cost came out to $620,920.
So they would have initially recorded that drilling platform at a higher value, including that present value, and also set up the ARO liability, right?
You got it. When that platform went online, they'd debit drilling platform for $620,920, credit asset retirement obligation for the same amount. Then over the next 5 years, they depreciate that $620,920 and also book that accretion expense on the ARO each year.
I think our research even had a nice little schedule showing how those amounts would change over time. In 2025, it showed an accretion expense of $62,092 and depreciation of $124,184.
Straight line depreciation, nice and easy, $620,920 divided by 5 years, boom, $124,184 per year. That accretion expense, first year is just the initial ARO liability times the discount rate, 10%. But that accretion expense, it creeps up each year as we get closer to that final payment. So they'd make those journal entries at the end of 2025, debit depreciation expense, credit accumulated depreciation for the platform, and then debit accretion expense, credit asset retirement obligation.
And by 2027, that ARO liability had grown to $826,444 with an accretion expense of $75,131 for the year. Depreciation stays the same at $124,184.
Consistent depreciation, that's our straight line method in action. That accretion expense keeps growing, though. Gotta love that time value of money.
Now, fast forward to 2030. It's time to say goodbye to the platform. They hire a company called Rig Reclaimers, Inc. Cost them $980,000. And at this point, the ARO on their books is sitting at $1,000.
Showtime. The liability comes due. Wildcat Oil, they cut a check to Rig Reclaimers for $980,000, so they credit cash. They've got that asset retirement obligation sitting on their balance sheet for a cool million, so they debit that to take it off the books.
Hold on. They had $1 million liability, but they only paid out $980,000. What happens to the extra $20,000?
That, my friend, is what we call a gain on settlement of the asset retirement obligation. Basically, they overestimated the cost, so they get to recognize a gain. They would credit an account called gain on settlement of ARO for $20,000. So the whole journal entry would be a debit to asset retirement obligation for $1 million, a credit to cash for $980,000, and a credit to that gain account for the $20,000 difference.
Nice little bonus for them. Well, we've covered a lot of ground today. From the nitty-gritty of capitalizing PP&E to those long-term liabilities that can really sneak up on you.
Yeah, it's more than just buying a building or a machine. It's about understanding the full life cycle of these assets, from acquisition to retirement. That historical cost principle is the bedrock, but it's also crucial to recognize that those costs can go beyond the initial price tag. We have to factor in everything it takes to get the asset ready for use, whether that's legal fees, site prep, installation, you name it. And then we have to consider those future obligations, those AROs, that are part and parcel of using certain assets.
So next time you see a company with a lot of PP&E on their balance sheet, think about all the costs that went into those numbers. And if they're in an industry with potential environmental or decommissioning liabilities, really pay attention to those AROs. They can tell you a lot about a company's long-term financial health. It's all about seeing the big picture, the full life cycle cost of an asset. Thanks for joining us for this deep dive. It's been a real eye-opener.